Every once in a while, a company drops an earnings report that makes everyone on Wall Street literally do a double take. Well, welcome to today's explainer, folks. We're going to completely peel the onion on Gartner's massive Q1 earnings surprise. We're talking about a performance that is full of fascinating and honestly pretty contradictory layers.
To really grasp this, we've got to start with the baseline. Analysts were essentially expecting Gartner to hit $3.77 in adjusted earnings per share. That was the number baked into everyone's models, factoring in the kind of cautious tech spending we've been seeing across the board lately. But then, boom, Gartner drops a massive $4.37. Now, in the finance world, beating by a couple of pennies, that's normal. Beating by this much, that's a whole different ballgame. It completely changes the conversation around a stock overnight. We are talking about a colossal 60-cent beat, literally coming in at 15.9% above expectations, which, of course, immediately begs the question, how on earth did they do it? Was this just an accounting fluke, or is Gartner finally turning into a real, undeniable growth story? Section 1, the earnings shock.
So let's look at the historical context here. We're not just looking at a beat against some analyst guesses. We're talking about real, tangible acceleration. Just look at Q1 last year, $3.53, compared to this year's jump, straight to $4.37.
That is a roughly 23.8% year-over-year jump. Guys, that's a staggering figure. 23.8%, that's the kind of number you expect from a tiny, hyped-up tech startup, not a giant, established information services firm like Gartner. So what exactly is fueling this? Well, first, let's clear something up right away. When we hear AI boom, we instantly picture data centers and glowing hardware, right? But Gartner does not make GPUs. They don't build servers or AI chips. Calling them an AI hardware company would be entirely misleading. Their product is actually totally invisible. Which brings us to Section 2, how Gartner makes money. To figure out this earnings beat, we need to see what executives are actually buying from them. And as you can see, Gartner is overwhelmingly an insights company. Sure, conferences brought in $78 million, and consulting did about $119 million, but look at that massive slice. Insights generated almost $1.3 billion in Q1 alone. They are selling intelligence. Companies are paying them massive amounts of money just to understand where technology is heading. And right now, the AI boom is creating absolute chaos for corporate executives. Every CEO is sitting in a boardroom urgently asking, which AI tools do we buy? How much do we actually spend? How do we fix our cybersecurity? Every new technology creates a mountain of questions, and AI just amplifies that uncertainty. And that uncertainty, that is basically rocket fuel for Gartner. They sell the answers.
Moving on to Section 3, the buyback engine.
So as it turns out, selling all this intelligence generates an unbelievable amount of cash. Check out these Q1 metrics. Operating cash flow hit roughly $391 million, and free cash flow was $371 million. That's a nearly 29% jump year over year. And hey, earnings look great on paper, but cash is absolutely king, because cash gives management choices. And management completely used that flexibility. They went out and repurchased $535 million of their own stock in Q1 alone. This is the financial lever they pulled. Think about it. When a company takes $500 million in cash and buys its own shares, it shrinks the total number of shares out there on the market. So even if the business is growing at a normal pace, the earnings for each remaining share suddenly look huge. And get this, they aren't stopping there. In April, the board authorized another $600 million for share repurchases. They are doubling down on this strategy. By aggressively shrinking the share counts, Gartner is ensuring their EPS will continue to look incredibly attractive to Wall Street. But wait, there's a catch. Section 4, the growth contradiction. Okay, we need to put our analytical hats on for a second. There is a glaring, massive contradiction hidden beneath this flashy headline. Yes, earnings per share shot up nearly 24%. But if you look at their FX-neutral contract growth, which strips out currency noise to show true underlying demand, it only grew by 1% on a $5.3 billion contract value. The bottom line is sprinting, but the top line, it is crawling. And it gets wilder. Their consulting revenue actually fell 14.7% year over year on a reported basis. Just let that sink in for a second. We are in the middle of the biggest enterprise tech shift of the decade with AI, and Gartner's consulting revenue went backward by almost 15%. That is a warning sign that investors absolutely cannot ignore. Look, Financial engineering is fantastic for a quarterly beat, but at the end of the day, buybacks cannot permanently replace organic growth. You can only shrink the pie so much, right? Eventually, Gartner has to prove they can actually sell more contracts and consulting hours to sustain this momentum for the long haul. Which brings us to Section 5, bull, base, or bear. The market is always looking ahead, so let's impartially lay out the 3 ways this could play out, starting with the bull case. In the most optimistic scenario, Gartner becomes the ultimate winner of the AI boom. That 1% contract growth, it's just a temporary lag. Soon, businesses realize they desperately need Gartner to navigate AI complexity. Demand surges, consulting stabilizes, buybacks keep rolling, and earnings absolutely crush expectations. Then there's the base case, the middle ground. Things are just fine. EPS stays perfectly healthy because of the buybacks, but contract growth is totally moderate. Consulting recovers, but slowly. The market essentially accepts Gartner for what it is, a highly reliable, high-margin info services company, but definitely not the next explosive AI tech darling. But then we have the bear case. In this pessimistic scenario, investors decide that one strong quarter just wasn't enough to change the long-term trajectory. Tech budgets stay tight, consulting stays under pressure, and organic growth completely stagnates. Worse yet, what if AI actually changes how companies consume research entirely? If core sales don't kick in, the buybacks eventually lose their magic, and earnings growth violently slows down. So we're left with this fascinating contradiction. A massive 4.37 EPS and $371 million in free cash flow, driving $500 million in stock repurchases. But sitting right next to all that elite financial execution is an incredibly anemic 1% contract growth. It is literally a masterclass in capital allocation happening right on top of a core sales slowdown. The next few quarters are going to be absolutely critical. Did they just beat Wall Street? Yes, for sure. But as we wrap up today's explainer, here is the ultimate question you have to ask yourself. Can Gartner turn this financial engineering into a lasting organic growth story? Are they a true AI winner or just a master of the buyback? Only time will tell. Thanks for joining me to peel back the layers on this one. Keep questioning the numbers, and I'll see you next time.